Picture this. You get your first real salary, and someone, maybe your dad, maybe a colleague, tells you the same thing they were told. Put it in an FD. It's safe. It grows. You can't go wrong. So you do. You open a fixed deposit. You lock in your money. You feel responsible, mature, like someone who finally has their finances sorted. But then, somewhere between scrolling Instagram and a late-night YouTube rabbit hole, you start hearing about index funds, Nifty 50, passive investing, compound growth, and suddenly, a small, uncomfortable question appears. Wait, am I leaving money on the table? That question is exactly what we're going to answer today. We're going to put index funds and fixed deposits head-to-head, not just the numbers, but the psychology, the risk, the real-life retirement math, and what each one actually feels like to live with over 20 years, because the right answer might surprise you. My name is Jawed. If you're someone trying to figure out where your money should actually go, hit subscribe and let's get into it. Let's start with the basics. What even is a fixed deposit? When you put money in an FD, you're essentially lending your money to a bank. In return, the bank pays you a fixed interest rate for a fixed period. Right now, most Indian banks offer somewhere between 6.5% to 7.5% per year. Your money is safe, it's predictable, and it's guaranteed. That word, guaranteed, is doing a lot of heavy lifting. Because in a world that feels financially chaotic, guaranteed feels really, really good. But here's the thing. Guaranteed growth and real growth are not always the same thing. India's average inflation rate has hovered around 5 to 6% per year over the long term. If your FD is earning 7% and inflation is running at 6%, your real return, the actual purchasing power you're gaining, is closer to 1%. Your money is growing on paper, but in terms of what it can actually buy you in the future, it's barely moving. Now, let's talk about index funds. An index fund is a type of mutual fund that simply tracks a market index, like the Nifty 50, which represents the 50 largest companies in India. When you invest in a Nifty 50 index fund, you're not betting on one company. You're buying a small piece of all 50 of India's biggest businesses at once. The philosophy is simple. Instead of trying to beat the market, you just own the market. And here's what the data shows. Over the last 20 years, the Nifty 50 has delivered an average annual return of approximately 12 to 13%. Not every year. Some years it drops hard. Some years it explodes upward. But over time, the trend has been consistently upward. Now let's look at the math, because this is where things get uncomfortable for FD lovers. Let's say you invest 5 lakh rupees today. In a fixed deposit at 7% annually, after 20 years, you'd have roughly 19.3 lakh rupees, nearly 4 times your money. That sounds impressive until you remember inflation. Now put that same 5 lakh rupees into a Nifty 50 index fund earning 12% annually. After 20 years, you'd have approximately 48.2 lakhs rupees. Same starting amount, same 20 years, but more than double the outcome. And here's the crazy part. That gap doesn't just come from returns, it comes from compounding. The longer your money stays invested, the faster the gap widens. By year 10, the difference is noticeable. By year 20, it's life-changing. But here's what most people don't realize. The math is only half the story. Because if index funds clearly win on numbers, why do so many people still choose FDs? Psychology. An FD feels like control. You know exactly what you're getting. There are no surprises. You don't open your banking app one morning and see that your deposit dropped 15% because markets had a bad week. That kind of emotional predictability is genuinely valuable, especially when you're new to investing. Index funds, on the other hand, are volatile. They move. Sometimes they drop hard and stay down for months. In 2020, the Nifty 50 fell nearly 38% in a matter of weeks. And while it eventually recovered and went on to reach new highs, living through that drop did not feel like winning. It felt like watching your savings evaporate in real time. And this is where most people make the critical mistake. They invest in index funds during good times, panic during a crash, pull their money out at the worst possible moment, and then swear off investing forever. They don't lose money because index funds are bad. They lose money because fear made the decision. So the real question isn't which one gives better returns on a spreadsheet. The real question is, which one can you actually stay invested in for 20 years without abandoning the plan? Because a 12% return that you panic sell during a crash is worth far less than a 7% return you hold patiently for 2 decades. Now, let's talk about taxes. Because nobody talks about this enough, FD interest is fully taxable as per your income tax slab. If you're in the 30% tax bracket, your effective FD return drops from 7% to roughly 4.9%. That changes the math significantly. Long-term capital gains on equity index funds held for more than 1 year are taxed at just 10% beyond 1 lakh rupees annually, which means index funds are not only better for returns, they're also more tax efficient, especially over longer holding periods. So where does that leave us? Here's the honest answer. FDs are not bad. They have a real and specific job to do. They are excellent for short-term goals, 1 to 3 years. They work well as emergency fund parking. They make sense for anyone who genuinely cannot handle seeing their portfolio value drop, because emotional stability has financial value too. But for long-term wealth building, for goals that are 10, 15, 20 years away, the data is clear. Index funds win, not because they're exciting, not because they're trendy, but because time and compounding work best when returns are higher, costs are low, and you stay invested. The secret isn't picking the perfect investment. The secret is picking something solid and staying the course long enough for compounding to do its job. Let's bring it back to where we started. That person who put their money in an FD because it felt safe, they weren't wrong to want safety. They were wrong to think safety and growth are the same thing. Real financial security isn't just protecting what you have. It's making sure what you have actually grows faster than the world around it. Use FDs for your emergency fund and any money you'll need within 3 years. Use index funds for every long-term goal, where you can leave money untouched for a decade or more. Stay consistent, keep adding, and most importantly, don't touch it when markets drop. That's it. That's the whole strategy. Boring, simple, and backed by 20 years of data. If this video gave you a clearer picture of where your money should go, make sure to subscribe. And I want to know, are you currently in FDs, index funds, or still figuring it out? Drop it in the comments, because the best financial decision you can make isn't the most complex one. It's the one you actually stick with.